Warren Ingram from Galileo Capital in studio with us this evening. My late grandfather would say, "Now, boy, never give advice. Wise men don't need it, and fools won't take it." Your advice tonight is don't do predictions.
Don't listen to predictions.
Yeah, so wise men won't take it, and fools don't need it.
That's actually, thanks so much. That's our topic. We're done.
We're done. We are absolutely done. This idea of predictions, I mean, and the Money Show is guilty. We do predictions all the time. Beginning of the year, it's quiet, and you go, so what's the market going to look like this year? And you make a series of predictions. If this, then that. If this, then that. And invariably nothing comes true because on day 3, something happens that makes all of the predictions completely null and void.
The most intelligent quote I've ever heard about this kind of thing was Mike Tyson, that well-known intellect. He said, everyone's got a plan until they get hit.
So, no, it's better than that. Everyone's got a plan until you get hit in the mouth.
In the mouth.
Yes.
And that's the point, isn't it? So when you look at a long-term prediction, and I'm saying long-term being a year, then that's what happens. Someone punches you in the mouth, and it could be Donald Trump starting a trade war with China, or it could be Eskom, with the nice week-long load shedding schedule. So to me, it's amazing how predisposed we are, though, to predictions, how much we really enjoy them. And I mean, there isn't, I don't think, probably since I've started talking to you on the show, there hasn't been a week in my life where someone hasn't asked me for a prediction.
But predictions give us a sense of comfort. I mean, predictions are rubbish because they're asking you to read the future based on what you know at this particular moment in time and what the past has brought and all of that sort of stuff. And so broadly speaking, you can gauge what the future might look like. You can't do specifics, but people take comfort in predictions. Oh, what's going to be the outcome of the elections? Well, the polls are suggesting this sort of proportion. Okay, well, now I know what I'm dealing with, but I'm going to wait just to be sure. But I can now sleep at night at least because I've got an idea of what the election outcome is going to be. Yeah. And what we know is that pollsters, certainly in other parts of the world, have got elections horribly wrong in recent years simply because they're not science.
They can't even get the direction right. Yeah, and that's the fascinating thing. So I mean, any kinds of these predictions. So I mean, just think through last week with the ratings. How many different opinions you must have garnered from people asking them what they think, and from really doom and gloom. I don't think there were many positive ones, but but it ranged from neutral to really doom and gloom. And every year, I mean, the ones I enjoy are all the economists being polled about where they think the currency is going to be.
And there are prizes. There are prizes for this sort of thing. There are Economist of the Year prizes for people who get. And you do see interesting trends though, because generally the most credible of the economists are usually in the top 5 consistently in terms of their ability to forecast and predict largely what at least the trends are going to be.
Well, the one I love, I think it was the Wall Street Journal, tracked it for decades, and the top economists in the US couldn't even get the interest rate direction right over a year. So more than 50% of the top economists couldn't even get that right. So just think, I mean, that's it's a up or down. There's no more than that. And a coin toss was proving to be more accurate than that. And so then we look at our beloved country, and we're quite a stable, predictable place, not much required there. Everything's exactly the same year after year. And
it is. It's always completely unpredictable and completely uncertain. Yes.
Rather wild. So I mean, I'll try to cast my mind back to how I was feeling at the beginning of this year, and then trying to get a sense of how everyone else was feeling just based on conversations. And generally, the sense was pretty gloomy. People were certainly not really optimistic, and the level of pessimism that had kicked in towards the end of last year was certainly in full swing by the start of this year. And that was so interesting because we get to the end of the first quarter, and why quarters are so interesting is that's when the market commentators and the market researchers tend to kind of sum things up a bit more succinctly and package information a bit more easily for us to consume, because otherwise we just get too much noise. And by the end of this quarter, we're looking at the stock market going up 7.1% for the first 3 months of this year. And I would argue almost no one would have predicted that. There would have been some lucky people that might have got the coin toss right, but for the bulk, based on our sentiment, based on how we were feeling, based on load shedding, based on the fear of Moody's, etc., there would have been some really good, well-positioned arguments as to why things weren't going to be great at all, and not the least of which would have been everyone waiting for elections to be over before things went up, and there we go. We're up at 7.1% for the year so far,
and the second quarter is like a greyhound out of whatever they jump out of the hatch, or
the starting blocks.
The starting blocks. The second quarter has started on a strongly positive note as well, which is not to suggest that the second quarter is going to be better than the first, or even going to maintain what happened in the first quarter. Our desire for prediction is for our personal comfort. What should we be doing then if we can't rely on predictions? Or, should we be, how do we immunize ourselves against this desire to forecast the future?
I think you need to eliminate the need to make short-term decisions in its entirety. So in other words, if you're looking at the decision about how much do you invest in shares, or how much should you have in South Africa, how much should you convert from rands into dollars or pounds or euros or whatever the deal is, those should be 20 to 30 year decisions, unless you're 80, and then maybe 10-year decisions. But for the rest of us, those should be very long-term decisions, and they should be based on your lifestyle, your requirements for life, what you want from life, your objectives, your concerns, your fears, etc. But the moment you put you bring out your binoculars and you look really far ahead, or your telescope, you're not too worried about what's going on directly in front of you. You're not too worried about this week, this month, or even this year. Because
horoscopes exist because people want to know the future. It's complete hocus pocus. People have gone to fortune tellers for years, had their palms read, at crystal balls looked into. People have tried to speak to the dead to understand what the afterlife, if it exists, might look like. All of this stuff is inbuilt in human nature to a greater or lesser extent.
So then let's look at the long term rather, and give ourselves more certainty there, because what we know about investment markets in general is they become quite rational, and dare I say almost predictable. Not quite. I'd hate to say it like that, but they do become more rational, and you can look at probabilities in a more numerical way if you look at things over the very long term. And that would have been the sense for the start of this year. That would have been the most rational thing to do, to say, when the markets are as cheap as they are, and that's purely on a mathematical basis, price earnings ratio. So how many years worth of profits today, this year's profits do you need to pay now at the current price to buy this company? When the market is looking at these kinds of valuations, it's going to reward you over the next 5 years. That immediately removes what happens in the next 3 weeks, 3 months. Those are decisions you don't need to make anymore.
And that is fine, except human nature dictates that I'm going to be motivated to change my mind 3 weeks, 3 months hence, when markets are down 5, 6, 7, 8, 9, 10%, because my nature is to panic when things go bad, because I find it impossible. When things are good, 5 years is years away. When things are bad, you really can't wait for 5 years to dig yourself out of the hole that you're in.
So that's where having just a one-pager game plan becomes better. It's a game plan you have to believe, though, and that's the point about something like this. If you say to yourself, I'm happy to commit some money to investments for a 10-year period, just as an argument. Yes, if the world falls apart, I need to access that money. If something really horribly goes wrong in my life, in other words, not in the markets, but in my life, that I do need to access the money. But
a terrible car crash, a bereavement, whatever the case might be.
Yeah. Something you can't predict today, and the very point of an emergency event happens. If you've got that 10-year view, and you say, right, I'm over 50 and under 70, that means that you can invest a reasonable amount of money into shares, because you've got time on your side if you've got 10 years, and you don't need access to the money for now, in any kind of planning that you don't need access to that money. Then you could say, you know what, I could put about 2/3 of my investments in shares. I can split it 50% SA shares, 50% international shares, because I have no cooking clue which basket of shares are going to do better. But what I want to do is I want to have exposure to shares. The moment you get to that kind of decision making, then what you need to know is 65% in shares tells you that in a bad time, you're probably going to lose about 15% of your money when the markets are falling apart like they did in 2008. Make peace with that already. Just make yourself the promise, I'm going to lose 15% of my money in one of the next 10 years. I don't know which one it's going to be, but it's going to happen. And what do I expect to get? Well, I expect to get somewhere around 11 or 12% a year for the next 10 years if I stick it out. Whatever's going on in the short term, you start to say, well, okay, so now the market's down 7%. Well, I was expecting a 15% year, so this is not too bad. I know it's coming. I don't know which year, but that's cool. I can deal with that. And when the markets are booming and you're getting a 30% year, well, that's great. I'm not getting too excited because it's not going to carry on.
The bottom line is you've got to take a 10 to 15 year view on an investment decision and stick with that investment decision and ride the good times and ride the bad times, because in as much as you can't predict what the next 5 years are going to look like, when things are really bad, your ability to predict the 5 years after that bad moment are probably even worse.
Close to impossible. I mean, emotions are a really terrible way to, or have a huge impact on our decision-making ability. So we have to be unemotional. And the only way we can be unemotional is to think really far ahead.
Yeah, but I just look at the best buying opportunity that presented itself in the early 2000s was 9/11. And I recall that day so clearly. I was sitting in an office in Rosebank, and a plane had flown into the World Trade Center. Probably a Cessna. Some guy got lost in the fog. And then it became very clear that somebody had deliberately flown an airliner into the World Trade Center. And I knew that there was a big conference happening at the Hilton here in Sandton. And so I jumped into my car. I wanted to go to this big investment conference to see what people were doing. And on the way to this conference, the second plane flew into the second tower. And so by the time I got to this conference, the conference had been abandoned. This investment conference had fallen apart completely, and people were just in panic mode. There were people on phones just desperately trying to get out of absolutely everything. And in the short term, that was a logical thing to do. A week later, though, things were recovering once again.
Yeah, and I think that's probably the most difficult thing because it's really difficult for people to profit from a disaster like that. And such a human issue. So to me, that would be a hard one for me, even if I was rational in that moment, which I certainly wasn't. I remember that as well. But it would have been hard for me to go and start committing money to markets at that time.
Yeah.
But when the markets just panic through normal kind of market moves, I do get excited. I have to tell you that's a time I really want to start buying, because I'm watching all the people running out of the proverbial burning building, not the real one. And that's when I think, okay, now's the time, because now people are thinking minutes ahead, hours ahead.
And and in that moment, you're predicting that things will get better.
I'm not. I just know mean reversion. I look at the math and I know what's going to happen.
That's a prediction. Warren Ingram, don't make short-term predictions. Gauge mathematically the long-term. Warren Ingram from Galileo Capital.